Well, Simon, favorite subject of yours, money, money, money.
Yeah, and we have another Italian guy in studio.
Yeah.
I know you hate that.
Oh, I love it. Are you
know.
kidding? It's the best. It makes my day. No, this is really good.
Good-looking guy, funky
Yeah.
glasses. What else is there? Right?
Fantastic. Very dapper dude. And of course, he knows a lot.
Yeah, that's
So-
right. That's why he's here.
He's here because he knows a lot. So we're going to get down to business. We're going to talk mortgages. So we have Michael Sistilli here, Client Services and Mortgage Investment Manager with Real Wealth Group. Welcome to the show.
Thank you very much for having me.
All right, let's get down to business. Let's talk about what is a tax deductible mortgage.
Well, a tax-deductible mortgage is simply the ability to borrow equity from your home with the intention of investing it in an income-producing vehicle.
All right, now Simon, why would people do that?
Well, to me, it's really simple. My question is, why would people not do it? Because essentially what you can do, and this is what Michael's here to walk us through, is you can borrow money you could borrow equity in your home.
All right, when you say equity, it's
Okay.
from the day that you bought your home, it's gone up in value. It's worth more than it was when you paid for it.
Absolutely. And so we get a lot of people, let's say in their 40s or 50s, they've worked hard, they've paid down their mortgage. And, what are we taught in school, right? Get a good job, buy a house, and pay off your mortgage.
Right.
Well, the problem with the pay off your mortgage component is you have all this money trapped sitting in your house. And let's say, for example, you have $200,000 equity in your home. In other words, your home is worth $600,000 and you have a $200,000 mortgage. So you could easily borrow $200,000. Now, we're talking average numbers for middle-aged people in the GTA. The problem with just leaving the money in the home is that if the market goes up 5%, you've just made 5% on your money. And 5% is not a fantastic return. But if we could actually use a vehicle, and I'll let Michael explain it, but if we could actually use a vehicle that allows us to borrow money at 3.5%, which is what it would cost to borrow it, and make 25 or 30%, then the simple question is, well, Aaron, would you borrow money at 3 to make 30? And the answer is simple, yes. But how do we do it effectively? And how do we do it in a way that we can actually save taxes?
And these are the steps that you do, Simon. I mean, when people come to you time and time again, they're coming to you because
Absolutely.
you help them build their real estate wealth. You're helping
Yes.
them make smart choices.
And it's a very common thing right now. It's one of the most popular things in the marketplace. But let's have Michael walk us through exactly what that entails and how people do it step by step.
Well, what most clients do is they come in and they first sit down and they want to know exactly how much equity do I have.
Mm-hmm.
So step one is to figure out the value of your home, correct?
Figure out the value
And you
of your
don't do that, but you have to work with a real estate expert in the area. So
Yes.
we figure out the value, and then
Then we proceed to access through a home equity line of credit the equity that is in the home. Now, you are able to borrow, you can refinance your home up to 80%. However, only 65% of that equity is available in a line of credit form.
Okay, and why is that, Michael?
It's to protect the lenders as well as the borrowers.
Okay.
Their main thought is that we will allow you to use your wealth, we'll allow you to use your equity to build wealth, but we do want to protect you at the same time.
protect and let's be
protect
clear,
their
and
shareholders.
protect the lenders and the shareholders as well. Yeah, but everybody wins.
Okay.
So step one, we find out what the house is worth. Step two, we look at the current debt, if any, because some people may have a small mortgage left on the house or a bigger mortgage. And then we look at, 65% of the value minus any existing debt gives us the amount of equity that we could borrow, right?
Yes,
So what's three?
Absolutely. So then we access the equity, and now we figure out what are we going to put it in.
So we've arranged, let's say, $100,000 line of credit so people don't get too scared out there. Because I've seen people do $500,000.
Yes.
But let's just say, even if you could tap into $200,000 or $300,000, you make the decision to get your feet wet by arranging a line of credit. You've now got a $100,000 line of credit. Now what do we do?
So let's say that the client's interested in a mortgage investment, per se, and that mortgage investment is going to pay 8% annually, which is paid monthly. So by borrowing the $100,000 and investing it, you're now making 8%. So let's say it's a 3-year term on that mortgage investment. That's 24% return. You're borrowing the money, as you said, Simon, at 3.5%, which is $291.75 monthly interest payment. That the mortgage investment will pay you $667 a month.
Well, let me take it back a step.
I thought
because,
Simon was good at numbers, but
Yeah.
wow.
Yeah, you're very good numbers. But for those people that are driving in their car and don't have a calculator, let's actually simplify it. In a nutshell, if I'm going to borrow $100,000, it's going to cost me 3.5% interest, let's say, and I'm going to make 8% interest. So in simple math, we're going to make 4.5% interest on somebody else's money, which is the banks, yes?
Yes.
Does that sound about right?
That sounds absolutely
So if
right.
you're listening in, I think that makes sense to almost anybody, right?